We are live. Hey, Vicki, how are you?
I'm good. How are you today?
Good, good, good. It looks like we've got some changes that we need to talk about.
Yes, we do. We do. Yes, last week it's been pretty, we've just kind of been waiting and waiting. And then last week they finally pushed it through. So yes, the PPP flexibility bill is the hot topic today. But we like flexibility, so that's good.
Yes.
Because it wasn't very flexible.
They're adapting to the situations.
They are. And I get frustrated with how much change there is because I've just never seen anything like this in my career with the government. But it's really it's almost like a good feeling because I'm like, oh my gosh, they're actually like understanding it a little bit. They're getting smarter as they go. They might be listening in some way. Like it's actually pretty interesting to watch. I think they've all gone through a mini MBA program these last couple of months. But yeah, they've made changes that are going to be very significant to most businesses. And we'll go through what those are, but there's still the concept that we are moving towards some sort of overall forgiveness for certain size loans. So what we're going to go through today, I don't think that's the end. There's more to come. There's probably going to be another bill at the end of the summer, I'm hearing. And there are various banking groups pleading with Congress to automatically forgive loans under $150,000 because it's just going to be a nightmare for everyone and actually cost businesses money to try to get this done right and the whole bit. So
keep going. Jackie's
all right.
saying that it's not on yet.
Okay.
But
all right.
Keep going. We're recording.
So there probably is more to come. The banking organizations, they are asking specifically for loans $150,000 or less to be automatically forgiven. So I think as we've been doing, right, or as we've been advising, you follow the rules as you have been, based on what they are at the moment. But just keep your eye out that there could be changes that still are to come. So the PPP flexibility bill, I'm stuttering today. The PPP flexibility bill did certain things that were fantastic. First, they extended the time period to use the funds from 8 weeks to 24 weeks. And that was just a huge change because, as we know, there were so many businesses that couldn't even open. So now we have to assume that, the economy is starting to open, the restaurants, the salons, the stores, they're able to open now. So a 24-week period, if they bring people back now, they should be able to use the funds within the 24 weeks. So that's alleviating a lot of that issue. Head count, there's still a head count requirement that they want you to get back to your head count levels. But it had been June 30th, and now it's been pushed till December 31st. Again, very significant. I mean, hopefully we are back to normal by December 31st, and that's not really an issue for anyone.
Fingers crossed, yeah.
Fingers crossed. And then also, again, with the flexibility piece of this, they reduced the amount that needed to be used on payroll from 75% to 60%. So when we think about the original calculation, it was essentially based on 10 weeks of payroll. So now you have 24 weeks to spend 10 weeks of payroll, and you only have to use 60% of it on payroll. So just the general math, as long as you didn't get rid of everyone, there's a very good chance that within those parameters, you'll be able to use the funds and be forgiven. So now you're left with 40% that can be used for non-payroll. As of right now, it's still the same rules around rent, utilities, mortgage loan interest, that kind of thing. But there there is a movement for some extra flexibility there to be able to be, so that extra money can be used on other things besides that, like PPE, and maybe capital improvements that need to happen, or leasehold improvements to stores to put up, plastic dividers and that kind of thing. So that also can be coming, but the main thing is that change from the 75 to the 60 on payroll.
But that's only for forgiveness. If somebody doesn't
That is
care
for
about the forgiveness,
right.
they can use it
Right.
basically for whatever they want.
Exactly. So the 75 to 60%, and we had talked about this earlier, there was some concern when they first went to 60% that the way they wrote the bill, it looked as if you didn't spend 60%, you weren't going to get forgiven at all. And they actually just clarified that. So folks are probably seeing that in the news headlines that they didn't mean it like that. It was just the way it was worded incorrectly. And it, 60% will get you full forgiveness. But if you get less than that, there would just be, the forgiveness amount would just be reduced by the percentage that you didn't get to 60%. So that was kind of that was the same as when it was 75%, but they just needed to clarify. So that's kind of been coming out over the last day or so.
But on the time, can I interrupt you for a second?
Yeah.
On the top, because I'm thinking about two things right now
Mm-hmm.
that are basically on different timelines. You've got the timeline for using the funds for 24 weeks from the time that you get them. Understand that. You have forgiveness that you can ask for. Has that timeline changed? Is it still 60 days from the time that you're, or whatever the time, what was the timeline?
Oh, that's changed. Because if you get 24, if you ask for 24 weeks, then the forgiveness, 60 days after that had, okay. So just to clarify for everyone, originally it was once the 8 weeks are over, you apply for forgiveness and the bank has 60 days.
Right.
Right. That, I haven't seen anything that has specifically changed.
But here's the problem with that.
Yes.
Because because you've got to meet that head count figure as an initial threshold. So if you don't have your people back until the end of December, how are you going to be able to get forgiven?
It's always been like that though, because 8 weeks was ending before June 30th for many people.
Yeah,
so
but this is a bigger gap. And
the
if
24
people are going to have to start paying the 6 months, they're going to have to start paying on whatever's not forgiven. And if they have, so they've got to do, I would think that they're probably going to do something that's going to rectify that.
Yeah, they're
timeline.
So nothing has been, the mechanics of things have not been laid out. And even when it was 8 weeks, the mechanics of forgiveness really were not laid out. But they did say in this bill that there is going to be a longer deferral time to when you have to start paying it back. I didn't see that. If you aren't forgiven. So I think that's going to be cared for. It's just that the mechanics of it, like for instance, they had a very complicated forgiveness application.
Right.
That has to be completely redone now. So now we need to get a new forgiveness application. We need to, the 8 weeks versus the 24, right? A business can opt to do still stay with the 8 weeks. So the 24 weeks is actually an opt-in. There's nothing out there yet what the mechanics are to opt-in. Also, which we haven't talked about yet, but one of the big changes also is that if you are not going to be forgiven because you couldn't meet those, even the new requirements, the loan repayment period has changed from 2 years to 5 years. So another example of, most businesses at this point have signed loan documents that say if they're not forgiven, it's 2 years. So now what? So new PPP, you have until June 30th to get a PPP still. New loans will have 5 minutes already baked into the agreement. But existing loans, if you've already signed a loan document and you think you're at risk of not being forgiven or not having the full amount forgiven, then you need to work with your bank to adjust the loan document and renegotiate that. So, we were talking about how people need to be proactive with their banks with how am I going to get 24 weeks? How do I get the 5 years? The banks probably don't even know yet. But like it was with PPP, you really need to be on them. So once they have the information or the way for you to do it, that you can be first in the gate to get those changes if that's what you need.
Right, because eventually they may put something in that's saying you only have a certain period of time, and the time may have lapsed to make that to make that request of the bank. So as Vicky just said, I fully recommend as well, this is something where you need to be proactive with your bank. And if you don't have a contact with your bank, you need to reach out to someone in one of the branches that you work with to find out who you need to talk to so that you can make the request if you want to kick it over from 8 weeks to 24 weeks. And if you want to increase the loan from amortization of the loan or the repayment term of the loan from 2 years to 5 years. That's the banks are not going to come to you on either one of those. So you need to go to the bank and be proactive with the bank. This is something that you need to do. You can't keep your head in the sand with it and think, oh, everybody will take care of me. You've got to do it yourself. Don't wait for anybody else.
Right. So, and then like I mentioned, so, you know, you still can get a PPP loan up until June 30th. June 30th was always the end of the program. A lot, the interest in the program really went down. I think there's like about 100 million still out there for PPP because there were so many strict requirements that, you know, businesses were getting scared away and were really shying away from it. But if you've been waiting, you know, to see if any of these changes came, or, you know, you're in a different position now where you think you can meet all these requirements, you know, it's still out there and you should reach out to your bank because we have until 6:30 to get that going. So, very, you know, interesting. It's interesting.
Now that we've got the PPP somewhat under control, what comes out next? But everybody that applied for EIDL loans are starting to get these emails from SBA saying, click here to find out how much your EIDL loan is. So I know you've been doing a little bit of research and learning a little bit more about the EIDL to get all of our clients up to speed on it. In the last 2 weeks, we saw a lot of those emails. So why don't you give us a little bit of what you learned from the EIDL?
So the economic injury disaster loan, I think most folks were most familiar with that that term when we were applying for the grants or the advances back in April. And then we know the story behind that. They turned in less money. Some people didn't even get them. But when you were applying for the advance or grant, as it was supposed to be, you were also applying for an EIDL loan. Now, back then, the maximum loan was $2 million, and then it changed. I mean, it changed like 5 different times. Right now, the maximum is $150,000. So that's the maximum that they're giving out. But what was interesting is like no one was hearing anything. And then all of a sudden, like every client of ours, you know, we're just getting emails from the SBA, hey, you're getting this loan. And no one even, people weren't even remembering, like, wait a minute, I applied for this. They didn't even know what it was. So we've had the great fortune of being able to read through some of these documents. And, you know, they are a 17-page, you know, pretty structured loan document. You know, just to review, it's a 30-year term loan, 3.75 interest, needs a lot of the requirements that a bank would, collateral and, you know, financial statements need to be submitted every year. You could have to have them reviewed by a CPA, which is a whole nother expense. They're going to be closely monitoring this money. So the same way now PPP, it's like you need to deal with all these requirements. It's going to get forgiven and then it goes away. This is a much longer term kind of relationship with the SBA. So you want to make sure that that is the right decision for you. It is, now PPP was very restrictive. EIDL is a little less restrictive, but it can only be used for working capital. So no owner distributions, no capital purchases, right? You're not going to go out and buy equipment. You're not going to buy a building. You're not going to do no investments. It's purely to keep your business running. And it needs to be tracked in detail. So, you know, if you get a $150,000 loan, you need to move that to another account and you need to be tracking every single dollar, keeping receipts, keeping everything, because the SBA can and most likely will come back and audit to some degree. and you need to be able to show how you spent it and that you spent it within the, the restrictions of the, or the requirements of the loan. So, a lot of our clients now are saying, well, oh, isn't this good that I'm getting this money? And we kind of have to have that conversation of, this is debt. This is not a grant or anything that's going to be forgiven. This gets you into a relationship with the, pretty strict relationship with the SBA, which is the same. Actually, I think the SBA relationship is harder than a bank. And is that something that's really right for your business? So, I like to ask the question, would you have been looking for a loan, anyway? Would you have been looking to take on debt anyway? And we always talk about...
From my experience over the last 20 plus years, SBA loans tend to be more onerous than bank loans. They tend to have more scrutiny and oversight than bank loans.
Right.
There's going to be additional expense that we already know every year, probably anywhere from $2,000 to $3,000 to have your financials reviewed by a CPA because they are a CPA firm, because they're requiring it directly as one of the covenants in the loan documents that annually you have to submit CPA reviewed financials. So now we have a couple of nonprofit clients that get audited every year that got access to EIDL. So it really does, that's not an expense to them. So then it's a question, is this good debt or is this bad debt? And we have to analyze it that way. But the first thing is, the first thing I would think in the decision tree would be to decide, am I willing to pay this $2,000 to $3,000 a year extra just to have access to this loan? Because even though it's a 3.75%, you got to look at the cost of the loan being that. So if it's a $100,000 loan, that's another 2%. So you're looking at 5.75 per year in interest, basically. Plus, you're being scrutinized by the SBA, and they're going to compare it to tax returns. They're going to compare your financials to tax returns. So everything needs to be in sync. So you have to, tread lightly here and be very cautious, cautiously optimistic, but you still need to be cautious in how you move forward. But I know, conversations with Vicky's very, very, just as a caveat and as a clarification here, Vicky is very, very conservative when it comes to bringing on debt in a business. That's why our clients usually have very good and sound balance sheets, and they're healthy because we have people like Vicky that are very, very conservative when it comes to bringing on debt. That we ask a lot of questions as to why to bring on debt. And that gets into the good versus the bad debt, which I'll let you take a crack at.
Well, let me start by saying the reason why I'm so debt averse is because it is very hard to manage. I think that business owners do not realize, well, first of all, it's very hard for them to understand how much money they're making and how well their business is doing when they're not remembering, and then they have and why can't they manage their cash flow? Like, I think I'm making money. I know I'm making money. My P&L says I'm doing well, but I never have any money in the bank. And it's like, well, because remember that loan you took out that you thought was such a great idea, and now you're paying it back $2,000 a month or whatever it is, that's why you don't have the cash, because you're paying back this debt that's been sitting out there for so long. And even this saying it's a 30-year loan, oh, 30 years, why would you ever want something on your back? I mean, of course you could pay it off faster, but still that longer is not better as far as I'm concerned. It's just a longer time for you to get into worse situation. So, with the EIDL specifically, I think if it's the difference between a company being able to survive for the next couple of months because of this tragic, this crisis, I would say, yes, okay, then that's a decision you're making, that it's better to save the business, do this, and you're going to take that, you're going to take that on. But if you don't need to do it, why do it?
Right.
I think that's really my thing. So, good debt versus bad debt. And this is a great, I'm not completely debt averse if there's going to be a return on that. And it's an investment essentially that you're making, right? Because it's not free money. You're going to have to pay it back. So are you going to get a return on this investment? What are you going to be able to grow? Are you going to buy, are you going to expand your business and now you're going to bring on, be able to make more money? Like, what is it going to do for you? But the problem with the EIDL is it is very restricted how you can use it. So it's hard to say this is good debt because it's only working capital, which is good if you need to stay in business, if it's going to keep you in business, right? But it's not, you can't use it for expansion. You can't use it for really anything new. So are you going to get any type of, ROI?
You can't use it for anything where you're going to get a you can directly correlate a return on investment because you can't use it to buy capital improvements.
Exactly.
You can't use it to buy another
business. The things that would generate new revenue and grow your business.
Above and beyond the interest that you're paying on it.
Right.
So yeah, I mean, it's, the thing though, that if someone is going to move forward with the EIDL or any debt in general, they can't look at it from a short-term perspective, as we always tell our clients. You got to look at the long term. You got to look at play the long game here. So you got to map out your cash flow, where your cash flow is incorporating your debt payments. Not think your P&L is your cash flow on a month-to-month basis, because we see it all the time that most business owners think their P&L and their cash forecasts are the same thing. And they're not, because there's a lot of things that are not on or recognized or realized on the P&L that contribute to cash coming in or cash going out. So you need to look at it, and we would recommend, and correct me if I'm wrong, because you're more in the trenches than I am nowadays, but what our feeling is you got to look at it for 18 months and do it a minimum on a monthly basis. Don't do a quarterly basis. Look at your cash flow over the next 18 months. See where you're going to be bad or where you're going to be low, where the cash flow is not going, that you could be underwater or getting close to going underwater, and say, okay, well, if I get through that, where do I come out if I have no influx, no additional influx? And always be pessimistic when you're doing your cash forecast report.
Right. And this is a risky time. So what makes me concerned is, like we've been saying, now's the time to, cut back on expenses, pull back, conserve, right? So this is not, you get this EIDL loan and hey, all bets are off. I have the money now, right? Like, because this is a risky time. We still don't know. Yes, the stock market's up, things are looking better, but we are in a recession. There's a lot of crazy things going on there. So, this is not like, oh, this is, free money that's saving the day. 6 months from now, when you start paying those, making those payments against it, and all it did was get you another couple of months of, paying your regular costs that you didn't reduce because you thought you had this money. Now you're not profitable and you have a loan, and it's the snowball effect. It is so easy to get into this, into this snowball effect. And I think that most business owners understand that because they felt that. And it just, if you're not taking action to make things better, make the business more profitable, make the cash flow smooth, and it all makes sense, this is not suddenly going to save the day or make things better. It can actually make things worse. So
along those same lines, when you're looking at this cash, when you're creating your cash forecast, you need to look at things that are beyond your control as well. For example, we have a client that's in the hospitality industry, $8 million a year client, but they process hotel laundry. And so now hotels have depressed occupancy rate. Occupancy rates are below 5% of what they normally are at this time of year. The industry is saying it's going to take 12 to 18 months to get back to normal. But they all put a caveat on it and say, if there's nothing else that happens, if there's not another shutdown, if there's not another wave of this coronavirus or whatever
Right.
virus. Or
Right.
on top of it, we don't even know if some of these hotels are going to open up again because some of them are small. So these are things that are outside your control as the business owner, but you have to be looking at that. It's not just saying, oh, I've always been able to spend $100 in marketing and make 10,000. That's
Right.
not, you got to look
It's
at
not.
it differently
Right.
now.
Right.
Or, you know, in normal
Right.
circumstances, we were getting $100,000 a month
Mhm.
because rates were this. Rates may not be there for 12 to 18 months if they even ever get back to it again.
And you know, I was on a call the other day with a webinar with various economists, and it was an interesting, depressing conversation because it was, you know, and of course that's like so it's like you look at the stock market yesterday and it's like, oh, everything, it's over, coronavirus is over, we're great, you know, and then okay, but now we're officially in a recession. Right. So now that's, you know, that's looking at historical information. So it's like all these conflicting things. But I mean, there was like 50% of the economists surveyed felt that this was going to last for 5 years. It was going to take 5 years to get back to December 2019, you know, economic activity. That is pretty significant. Now, not to, you know, not that you say, oh, you know, the world's ending, it's over, you know, that my business is over. But really, I mean, that's pretty significant. So to do something so drastic or make any assumptions based on the past is not, you just can't right now. You can't. You have to be as conservative as possible and, like, you know, on the pessimistic side to be safe, you know, just to be safe, not taking a lot of risk and just riding through some of the storm. So, yeah.
So I know that moving forward, we're going to start focusing more on tips and things like that, and really how to run businesses more efficiently, more productively, and more profitable. Have you thought about what you want to talk? I know today we were going to try to get into good debt, bad debt, and we got into it a little bit, but I mean, obviously the overcompensating or the overriding thing was PPP and EIDL. But for next week, do you have an idea of maybe what topic that you are thinking about?
Really?
I'm putting you on the spot, Miss Vicki.
No.
Scolded, and she's going to bring out the school marm in her, and she's going to smack my wrist with the ruler.
Well, look, I know I don't have my specific topic for next week, but what do we focus on, right? We focus on cash flow, profit, and growth, you know, and that's where we really, you know, we have our blueprint and the way that we look at that we will help a business. And we want to start focusing more on that so that, you know, our audience can, you know, you've gotten through this PPP stuff. Most people have it now, have gotten even through most of the time period of using it, right? So now it's really down to the reality of this is what you have left. This is what you're dealing with. This is what's happening in the economy. And now how do you make things work? You know, still keeping you know, and so we'll definitely start using our blueprint more in the conversation, or really defining what we're talking about based on that.
Absolutely. And everybody, you got to understand, we're tired of talking about and researching PPP and EIDL. We want to get the information to you and get you accurate information that you can use, but we're also very tired of talking about it. We'd rather talk about, okay, what are the opportunities that are potentially going to present themselves when the dust settles? How can you as a business owner take advantage of those opportunities to create a more valuable business for yourself? So if you've got any thoughts or requests on topics or questions, please over the next week, pop them into the group, post them in the group, and then Vicki will take it from there, and we'll see what we've got to talk about next Tuesday.
Yeah, I mean, and that's a great point. I mean, we're here having these conversations with all of you, and we would love to dive into a specific problem that someone is having, you know, and we're trying, you know, we're keeping it sort of high level because we are trying to kind of hit the points that maybe everyone has. But I think that when you share maybe some challenges or concerns, it ends up helping everyone, and it's a good discussion to have. So absolutely, that would be fantastic to be able to focus on anyone's specific issue that they want to talk about.
So, all right. Well,
Yeah,
anything
great.
else, Miss Vicky?
No, that's it for today.
All right. Well, everyone, stay safe and keep well, and we'll talk to you next week.
All right, thanks.
All right.
Bye-bye,
Bye.
everybody. Bye.